unit trust is actually the name of a form of collective investment. How I mean by collective investment? All these things represent the money, right? Okay, this is like a pool, a tabung of investment. So what happens is you as an investor, you want to invest through the stock market, in the bond market, in the money market, all this, and you take some money from you to inside. Some money from you to inside, and then some money from you to inside. So what happens is, this is where you pull all your money together into one tabung. That is what it calls the unit trust. So that's what it's meant, collective investment scheme. Collect. Understand collect? Collect money to inside the pool. So what happens is the fund manager, the one who manages the money, will take this whole money and start to buy shares in the stock market. Malaysia shares, US shares, China shares, and so on. Not only that, they also buy the bonds. Bonds are actually government bonds, corporate bonds, the company bonds, and other putting money in a bank. They call it the deposits. And that is called under money market instrument. So the major three areas are equity, bond, and money market. This is what I meant by collective investment scheme. Investor with similar investment objective. If you want to invest in China fund, China stocks, instead of you buy directly to China companies, you put the money all inside the pool here. Okay, those who want to buy China company, China stocks, all put your money inside this tabung. This is where the unit trust scheme, the unit trust fund. And the fund manager will buy China stocks only. And if you say decided to buy another one, let's say you want to buy Australia companies, what happens? The same thing, the fund manager will collect money, those who want to buy Australia companies, put your money inside. And then they will take the money, whatever inside the tabung, buy Australia companies. Malaysia one, same thing. So every single one, a fund has their own objective. So this one may be a China fund, this is the Australia fund, and Malaysia fund will be another one tabung. So that is the meaning of unit trust. Collective investment scheme, you collect, you use whatever money, buy companies, buy stocks, buy shares. Okay, so that is basically unit trust. And portfolio of securities and other assets. And they buy a lot of companies. They don't buy one company, they buy many companies. Maybe 50 companies, 60 companies, and a market, local company, US company, or foreign company, depending on the objective of the fund. Are managed by professionals. So we have our fund managers who are focused on managing the buying and the selling of the stocks, the bonds, and money market. Their main focus is to manage the money inside the pool. Instead of you as a normal working people, doing your own business, working for others, you don't have time to study the stock market. So the easiest way is get somebody, give the money to them who are professional in it, let them do all the investing for you. Let them do all the planning, strategizing, buying, selling, when to buy, when to sell, what price to buy, what price to sell, let them handle it. Because they are always focused on that. So you take away your worries and no need to have your skills, no need to have your knowledge, you pay somebody to do it. So alright? So this is how unit trust is all about. Okay, let's study history. The main company, the first one was called Unit Trust, Malaysian Unit Trust Limited. It was started in 1959. So it's a very old business. It's not something new that was just launched like 5 years ago. And that was the first one that was launched in Malaysia. Unit Trust itself has been around for many, many more years. Only in Malaysia it started in 1959. Just remember Malaysian Unit Trust, 1959. That's it, 2 years after Merdeka. Just remember that. You remember what is Merdeka year, right? 1950 what? 57. So 2 year old become Unit Trust already. So that is how you can remember better. Associate with what already you know. First Sharia fund or by Arab Malaysian in 1993. Alright, 1993 is the first Sharia compliant fund by Arab Malaysian, Unit Trust Berhad, and the bond fund, first bond fund by the RHB Islamic Board in year 2000. The master prospectus is they compile all different funds together. Every time they launch a fund, they come out a new fund, a new tabung. They will have to come out with one document to tell about what the tabung is all about. what the tabung will invest in, what kind of funds, what kind of companies, the strategy, investment objective, everything they have to come out. Then the prospective investor, the new people want to buy, they will read the book first, understand what the investment is all about. Then they say, okay, this is what suitable for my investment objective. I will subscribe or I will contribute, I will invest into this fund. Before that, they must launch the prospectus for people to make an informed decision before they invest in. Why they call a master prospectus? Because all the old funds that they have launched earlier, they cannot be having too many books. It's like 100 over funds. They cannot have 100 over books. It's too messy. What they do is they combine everything into one book. And that book is called Master Prospectus. Okay? Whatever new fund launched this year, they will combine it into next year's Master Prospectus. The next book that they're going to print and become Master Prospectus. Insert inside with it. So you compile all the different funds into one book called Master Prospectus. Alright? Why do you want to do that? Because we want to make sure the customer or the investor have an informed decision before they invest into the fund. Prospectus has to be reviewed every year, but it's expiry date. So remember your exam, got expiry date. Okay, what's inside the prospectus? The master prospectus is a table of content. It will tell you exactly what's inside, the definitions of the terms they use, what it means by this and that, and the corporate directory, which means all the branches of the company are all inside. Who are the directors, who are the investment committee, everything is inside for you to read. What the objective of the fund, everything is inside. Okay, key data section is part of it where they tell you all the basic information, the fund objective, fund investment strategy, which country they invest in, how many percent equity, how many percent local, how many percent bond, everything is there. Right, you miss a lot of things now, don't worry, by the end of the day you will roughly know what it meant by the bonds and so on. Okay, the key data section is to tell you the summary, the important parts. For example, charges, how many percent you have to pay, management fee, trustee fee, everything will be highlighted there. So you know what are the fees and charges you have to pay on yearly basis, based on daily calculations. Okay, and they will also introduce to you in the unit trust scheme, what they are, how they calculate the price, how they calculate the investment amount, everything will be shown inside there as well. Basically, the whole book is all about letting the investor know what they are coming for, what are they investing and how they're going to be charged and how all the investment is all about. Okay? UTMC details. What is UTMC? Trustee. This is also another thing about unit trust is where you have a trustee. Trustee means you let that company handle the money. So this money inside the tabung is not under the company or UTMC name. It's under the trustee's name. This is where you trust a third party to hold the money on behalf of the investor and different and separate from the UTMC. So the money is under a trustee's name, but I use the money to buy and sell. You get the idea? Okay, let's see this one. Let's say you are all the fund manager. Okay? You are the trustee. The rest of you are the investors, the unit holders. So there are three main parties inside: unit holders, trustee, UTMC. The fund manager all under UTMC. So when you pull the money is under the trustee's name. The trustee will keep the money on your behalf. Why? In case the UTMC cabut with your money, the money cannot be touched. This is to protect you. And the trustee, they have their own law. Trustees Act 1949. Trustees got a law to protect and hold the money, and they also cannot touch the money. They can only keep on behalf. This is how the unit trust, the trust comes from. The trust structure, having a trustee taking care of your money on your behalf. So if anything happens to the unit trust management company, it doesn't matter. Your money is still safe, held by the trustee group. If anything happens to the trustee, the law says the trustee cannot touch this trusted money. So it's a very, very safe investment structure. Okay? So this is how and why the trustees come in. And they have the details. Later we'll go to more details. This is just an introduction only. Okay, and then the fund information all inside. So they will tell you who are the trustees inside and what are the information in the funds. Historical financial highlights is the past story, what happened, the fund, how much money they have made, how much, where the money come from, the basic, the fund performance, how many percent was on which year, all are inside the fund information. They will have you a record inside the report. So you will roughly know the last 5 years, the last 3 years, the last 1 year, what are the fund performance. So you will have some idea whether the fund did well, not so good, and so on inside the report as well. Because you want to know how's the performance, right? If you want to know before I buy, can you tell me what is the performance, the history? The master prospectus have the info. Okay? Now PTR is a formula, it's called portfolio turnover ratio, to measure how active the money is being bought and sold. I will show you the formula later. Okay? And the other one, and the sales and purchase of the units. How the units are being bought and how is it being calculated, the amount of money, you go through the formulas later. Next one, what are the rights and the liabilities of the unit holder? What you can do, what you must pay. Plus the taxation. How is the tax being affecting your investment? Accountant's report. The accountant will give you the summary of the report. How much money they have, how much liability they have, and tell you what is the asset of the fund. How much the table has right now at that moment of the closing date. Also have other disclosures inside on what they can do, what they cannot do. So those are all the details inside the master prospectus. This one you don't worry too much because the main focus are the front ones. Okay, let me show to you the graph on how the structure of unit trust works. First thing, the unit holders. Remember I mentioned to you all of you just now? So the rest of you are the unit holders. You pool your money together, called money pool for investors, and you put inside the tabung. Okay? This tabung is here, unit trust scheme. Alright, unit trust scheme is like a collective investment scheme, right? Remember I told you? So that is a tabung where the trustee, the whole gang here, take care of the money. Whereas the fund manager, UTMC, this side, will use the money to buy shares in Malaysia, in China, in Hong Kong, in China, US, and so on. So they are the ones who decide to buy and sell. But the money is always under whose name? Trustee's name. To safeguard. So the unit holder don't need to worry about buying and selling because you know you have to sign a check. Sell, you sign, buy, you receive the account. So those things are all done by the trustees for you already. So actually you are worry free. You just put the money there, don't need to worry about. Everything run by the system already. Okay, that is where the UTMC administers the operation and the trustee's main job is to safeguard the assets of the unit trust scheme. They take care of the money. And then what happened? The unit trust scheme, I already told you, right? They buy into companies, right? Those are based on the authorized investments only. If the fund is a China fund, they only buy China companies. If the fund is an Australia fund, they only buy Australia companies. If they are only Malaysia fund, they buy Malaysia companies only. They cannot, China fund, go and buy Australia. Alright, not allowed. Unit trust management companies, what do? They are the ones who handle the buying and selling. They will report to trustee on the investment. So they will report the trustee, okay, I buy how many, how much today, I sell how many, how much today. They will report to the trustee. So the trustee will check everything okay according to the objective or not. And when they promote and distribute, so unit trust management company will do the marketing to promote the fund, and people will invest into the fund. Okay, next one, they service the unit holders. So the unit holder want to buy, want to sell, want to transfer to another person, want to switch to another fund. All these are done by the UTMC. Right? Distribute the income. So whenever the fund declare a distribution on yearly basis, they will send the money to the unit holder. They will calculate how much and send the money to the unit holder. And calculate the unit price, whatever amount of money they have, divided by the number of units that people have, that is your unit price. The total asset inside the tabung divided by the number of units that people bought, will become your unit price. Okay? And then repurchase. Repurchase means what? They buy back. So if the customer say, I invested 1 million, and then they want to use the money after 1-2 years or whatever, they say, I want to sell back, I want to take back the money. Not 1 million, but maybe only 300,000. They allow the facilities to redeem the 300,000. So they take back the 300,000 worth of the investment. And the balance will still continue being invested. Okay? And maintain a registration of the unit holder. So depending on who invests, how much, when, everything, they have to keep the database, the records. So far so good? Now, trustee. The trustee is the one who takes care of the investment under their name, right? So basically means they will safeguard the asset. The asset is under their name. And then they ensure the funds are invested according to the deed of objective. Remember just now the fund manager have to tell trustee what I buy, what I sell? So the trustee will check out everything okay or not, then they continue. If not okay, then they will highlight the problem. So the fund manager will do to rectify the error. Supervise operation, they overlook how the fund manager is doing, everything okay or not. They will have an overview on the buying and selling and so on. Plus, they approve and monitor all the financial transactions. So the money all go through their name. Everything buying and selling, they take the money, buy the shares. The fund manager just decide what to buy, what to sell, but the money will be under the trustee's name to pay for it. And the fund manager say, okay, we sell. So the money will be paid to the trustee's name because all the time the money is under trustee's name. So okay, that is the trust structure. And then collect all income. So if you invest in shares, the dividend come in, pay to the trustee. Because why? The shares are all under the trustee's name. The trustee will receive the dividend and the interest. And they put inside the pool of the money. Deed is like a contract. Contract on how they operate the structure. Because the deed is a contract between the three parties. UTMC, trustee, and the investors. They will have a contract, what you can do, what you cannot do, what to do if you want to change something. So this is where they highlight the rights and obligations of a UTMC, the rights and the duties of the trustee, what they must do, plus the rights of the unit holder, what you can do, what you need to do, how much you need to pay. They are all in the contract. It's like a sales and purchase agreement. The wording is legal documentation of the wording. Okay? And then they will also state down there what's the maximum fees payable by the fund to the fund manager. Inside the contract already stated. You cannot charge 20%, 30%. It's not it's stated down there, maybe maximum allowable is only 7%. So the highest the fund manager can charge is only 7%. Anything above that cannot charge. And authorized investment. Where are the investments going? China companies, Australia companies, US companies, Malaysia companies are all stated inside the deed already. Because the deed is for different funds. One fund has their own deed as well. Every one of them have it. Like a contract lah. Okay? And valuation. How they calculate the unit price, how they calculate are all stated inside the deed. Alright? And the outline, the way any changes to be done. If you want to change anything on the contract, you have to do these procedures. Alright, now, what are the features of unit trust? One, investment, collective investment scheme. What are other collective investment schemes that is available in Malaysia? Unit trust is only one of them. The other similar ones is your pension and provident fund, EPF. What happens? Similar, right? The worker contribute to the EPF fund. The company contribute to the EPF fund. So they collect the money in the EPF. EPF will use the money to invest, local or foreign. Similar. So that's what they call collective investment scheme. Besides that, you have your insurance. Insurance policies are also like that. The premium collector, the fund, the insurance company managers, they will buy into their own authorized investments. Next one, your pilgrim fund, tabung haji. You pay, contribute every month, right? Similar concept. And the other one, investment link. Investment link also from insurance company, but their structure is similar to unit trust, where the fund manager in the insurance company take the premium from the insurance customer and they use to invest as well. So they are also very similar to unit trust. That's why as long as you collect money and use the money to invest, it's called under collective investment scheme. Alright, how do you measure your investments? Every one of you will have, to be fair, they use units. So depending on when you buy, the unit price will go up and down every day. Alright, if the stock market is doing very well, the unit price will go up. So you buy at a higher price. But if the stock market is not very good, there are some bad news everywhere, the stock market price drop, the unit price will drop. So if you buy at that time, you will buy at a cheaper price. So just like a pen here, the pen is always the same price, assuming. So if you buy when a business is doing very well, in a shopping mall, maybe the brand price higher. But if you buy another shop, want to close down already, business is very bad, so the shop want to close down. So you will get a discount on the pen, right? But when you bring the two pen, they are same thing. You buy from the shopping mall, more expensive. You buy from the shop that's closing down, they're selling at a very cheap price, you get the same pen. So same meaning, when the market is doing very well, you pay higher for the same price. And when the market is going to crash, the owner want to lose money, they don't care, they sell as much as they can, as fast as they can, the price is cheap. But when you compare, the unit is still the same. So you can buy the same unit at a 30 cent, another unit at 20 cent, the same number of units are combined together. So you do not know what's the average price right now. One pen, let's say 130 cent, one is 20 cent, the average price is 25. So the pen worth 25 cents each. They don't differentiate this pen from shopping mall, this pen from Kedai Runcit one. No, it's all the same pen. Do you know which one is from the shopping mall? Do you know? Don't know, right? Same thing. The units are all equal. They are all the same. No such thing as higher price units or lower price units. It's all based on the market price of that day. You get the idea now? And what they do, they get returns by distribution and a capital appreciation. So remember I told you the interest come, the dividend income. So how they return back to the owner, the unit holders? Maybe once a year they declare, okay, we have some money ready, we have quite a lot of money inside, I don't want the price to be so high, I want to reduce the price. So what I do, I will return back the units to all of you. So I return to you, I return to you. That is called distribution. Alright? And that will lower down the unit price tomorrow. In fact, not tomorrow, immediately. If I have $1 here, and I sell 2 pence away, it becomes 80 cents. So every unit becomes 80 cents. Because I return back your 20 cents to you. You get the idea now? That is how it meant by distribution. When you return back, the unit price will drop immediately. Because it's your own money, return back to you. If you want to say it's profit, may not be considered as profit. Because why? It's taking your own money, return back to you. Let's say you buy at 80 cents. Alright? You buy this whole towel here, 80 cents, right? And you buy 10 of them, let's say 10 of them. So 8 ringgit, right? Total 8 ringgit, 80 cents, 10 of them, right? And then when they invest, they got more money coming in. So the whole value become 10 ringgit. So basically what? You pay 8 ringgit, you get 10 ringgit. So now each unit become 1 ringgit. You go divide by 10 units, right? Imagine these are all 10 units. So what you do, you get 10 units, you return back to you the 2 ringgit. So what happens? It becomes 8 ringgit, right? The unit price now becomes 80 cents each. So it's your own money returned back to you. So if you consider that as what? Profit? I don't know, you return back your whatever extra back to you. So now your value become 80 cents again. No? If you consider that as your profit, you can consider it as a profit. Alright, because you say I paid 80 cents, I become $1, they give me back 20 cents, the fund become 80 cents again. So the 20 cents can be considered as a profit if you want to think like that. Alright? And investment opportunity for small investors. Why? If you want to buy a big company, let's say you want to buy public bank shares. Public bank shares now around 24 ringgit, that's it. You want to buy, you have a lot of money. Let's say you want to buy 1,000 shares, you have to have 24,000 ringgit. Just to buy 1,000 shares of public bank. One lot, alright? Now, how many of you will have 24,000 ringgit to buy like that? Some of you just started work, may not have enough savings. Tak boleh lah. If you have got $1 million, no problem. So, if you have a lot of money, you can buy anything. But if you are a small investor, you only have 2,000 ringgit, you cannot buy because 24,000. So this is where the opportunity for small investors like those starting up, with 2,000 ringgit, 1,000 ringgit, you can also start buying the shares, but through unit trust. So what happens is when the pool of money of 2,000 from every one of you, I got a lot of money, right? Then I can buy public bank shares. Let's say I collect 2,000, 2,000, 2,000. Let's say I got 100,000 inside here. So 100,000 I can buy a lot of public bank shares already. That is what the whole structure of unit trust is all about. Allowing small people contribute small amount, but when we have a lot of big pool, we can buy a lot of other investments. Same like buying overseas. If you want to buy overseas, first thing, you don't have a skill, you don't have the knowledge, you don't know what to do. And your money too little, nobody wants to help you. So this is where unit trust can help. Unit trust, they don't really care. As long as you are above the minimum uniform of money, they will convert your units back into cash. When you buy, cash convert to units. Then invest, right? When you want to take out the money, your units will be sold off at that day price. If you bought at 20 cents, after a few years it becomes 30 cents, you sell at 30 cents, so you have a capital gain. Right, the ownership are in units, that's why I mentioned just now, you buy different day, different unit price, you pay for the price of the day. Find quoted as net asset value. What do you mean by net asset value? That is the actual amount you will receive if you sell off. So it's very straightforward. One price buying, one price selling. No confusion of single, like the bid and spread, buying price, selling price. Confuse everybody, right? So what they do is they use NAV. Net asset value. You buy, you pay that price. You sell, you pay that price. One price for all. Easy to understand. And the total NAV will be in the ringgit lah. 1 unit 10 cents multiplied by 1 million unit. How much? 10 cents times 1 million units, 100,000 lah. If the unit become 1 ringgit, 1 million units, you have 1 million ringgit. As simple as that. So the unit price multiplied by your number of units will become your ringgit value. Unit price times number of units equal to your ringgit value. You'll have NAV, the total fund size is 100 million ringgit. Per unit is they have 400 million units. So how much unit for one? How much price for one? So you have to take 100 million divided by the number of units. So ringgit divided by unit, you got ringgit per unit price. You understand the formula? How to remember the formula is straightforward. You have your ringgit divided by units. So you get ringgit per unit. Let's say your 100 million divided by your 400 million. Mathematics, the equation, the million will cancel out each other. The 400 will cancel out each other. So 1 divided by 4 equals to how much? 0.25. What is left behind? The dollar sign, isn't it? Per unit, so? Because it's 4 million units. You got the idea? Ringgit divided by units. The formula ringgit and per unit still remains there. That is, if you use mathematics, you cancel off the units value. Right? The ringgit per unit is still there. So this is how you remember. How to calculate? Sometimes you confuse. Is it unit divided by ringgit, ringgit divided by unit? Just understand what is the unit price, ringgit per unit. So you take your 100 million ringgit divided by 400 million units, you got 25 cents each unit. Okay? That is how I remember the formula. Which way to divide? Just follow the numbering. Ringgit per unit, ringgit divided by units. Okay? It's all here. You cancel off everything. M divided by M equals to 1, isn't it? Your algebra? Mathematics school. So 1 divided by 4 is left behind. The ringgit still remains there, the unit still remains there, it will still be there. If you say, I want to sell back, right? So they will take the unit, multiply by 25 cents, you get back your cash. The NAV per unit, how they define the NAV unit is the asset minus all the liabilities divided equals to your net asset value. So the asset means what? All the shares, all the bonds, all the money market, whatever they buy in the bank, money in the bank, everything, that is your total assets. Then they have the expenses, right? Management fee for the UTMC, trustee fee, brokerage fee, everything they have to pay. That's why it's calculated on daily. You will minus, the net value become your net asset value. So that is the total amount. Like what you mentioned just now, if got 100 million, let's say the minus of all the expenses 100,000. So they got 999,000 ringgit only. Divided by the number of units. That is the unit price for that day. Alright? So investments are market value. That is where the price up and down every day. Because it's based on market value. You may buy at $1, it can be 120 today. But tomorrow may crash to 80 cents. So today the price go up, tomorrow the price go down, depending on the market value. Alright? And all the expenses, net asset value. So total NAV is computed on daily basis based on business days. Now unit pricing. Forward pricing, what is the NAV will be known at the end of business day after the relevant number is posted. So what you do is, all the money you have, right? They would not know the fund price until tomorrow.